I care about the seasonals because that we know becomes the base case for investors, just like August was a month everybody was wary. So then what you have to build in September is, are there things that can be positive surprises for markets? And to me, that's going to be the Fed.
A positive surprise?
Well,
a surprise at this point?
Okay, a positive versus the base case. Because if you look at all the Septembers in the past, this time is a Fed on hold that's finally cutting. So that makes this September better. And then the idea the ISMs could recover, which really doesn't usually happen in the fourth quarter, but it could finally happen. We've had 29 months of the ISM below 50. So I think that we could have a better than expected September, October, November, December because of the Fed cutting and now the ISM turning. I might say that investors have been now patterned and bracing for NVIDIA to sell off after they report tomorrow. And yet, I think the visibility and I think the conviction on AI is actually stronger. So I think there's a chance NVIDIA rises dramatically after they report Wednesday after close. Okay.
Banks might be the biggest surprise winners of the AI boom. Fundstrat's Tom Lee says financials could be where the real opportunity lies right now. He argues that banks and financial firms are turning into second-order beneficiaries of AI, while also getting regulatory support to expand on blockchain. Put those forces together, and giants like JPMorgan or Goldman Sachs could see profits rise sharply, driving multiple expansion. And here's the kicker. Finance makes up about half of the U.S. economy, but nowhere near half of the market index. That leaves room for a serious re-rating. Strong earnings from major banks and a healthier IPO pipeline are already signaling in that direction. On seasonality, Lee pushes back against the usual September gloom. Yes, the month has a weak reputation, but that pessimism may set the stage for upside surprises. The Fed is expected to pause, possibly preparing to cut rates soon, while the ISM index could rebound after 29 straight months under 50. Put it together, and the stretch from September through year-end could look a lot stronger than most investors think. Finally, Lee points to Fed leadership. Whether Jerome Powell stays or a successor takes over, the market is looking for a smooth transition that reassures investors about central bank independence. That confidence will matter just as much as rate policy. For now, markets are betting heavily on a quarter-point cut at the September 16th to 17th meeting, which would bring the Fed's benchmark rate down into the 4.00% to 4.25% range. Futures put the odds of that outcome at 86%. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
I know investors are really anxious and NVIDIA has not performed well the last few times it's reported, but the story arc there remains that that is one of the most important companies in the world in the middle of the biggest structural change in the world economy. So I think NVIDIA still is a great story. It really wouldn't change our thesis if the stock reacted poorly. Well, I think everyone's trying to get situational awareness. Like, is this inning 1 or 2 or late innings? Because we know there's been a lot of value creation and a lot of capital that's flowed in. And we know that Silicon Valley has seen a boom of companies with $100 million annual run rates, like in record time around AI. And a lot of people want to ring the bell at the top. But to me, it still feels really early because there's such a limited number of stocks that public investors can buy that represent a direct play on AI. It is a risk. I guess that's really the next stage of what we have to see is how does the market accept now adding to the roster of direct AI plays, beyond just Figment. And I think, if we look at the next 12 months, there'll be a bevy of IPOs, some really big companies that are later stage. But if they're bought and they produce good growth and their stocks perform well, I would still say that still means we're early. I think there's a bigger upside in the owning financials right now because financials are benefiting from AI. Okay. So they're the second order beneficiaries. Plus they're getting the green light to build on the blockchain, which could really make JPMorgan and Goldman's business models so much more profitable and change their multiples, expand them. So I think, yes, I'm still bullish on AI, but I actually think the financials are really one of the legs that drive us the next 12 to 24 months. Because, at the end of the day, when you look at GDP, for every unit of economic activity, there's one unit of financial. So financials are half the economy, but they're not half the index. Now, I'm not saying they're going to get to half the index, but they really should re-rate. I mean, I think what we're even this quarter, right? The numbers from JPMorgan, Goldman, and the financials, and look at the bullish IPO. These are all good signs to me that you want to be overweight financial. I care about the seasonals because that we know becomes the base case for investors. Just like August was a month everybody was wary. So then what you have to build in September is, are there things that can be positive surprises for markets? And to me, that's going to be the Fed.
A positive surprise?
Well,
a surprise at this point?
Okay, a positive versus the base case. Because if you look at all the Septembers in the past, this time is a Fed on hold that's finally cutting. So that makes this September better. And then the idea the ISMs could recover, which really doesn't usually happen in the fourth quarter, but it could finally happen. We've had 29 months of the ISM below 50. So I think that we could have a better than expected September, October, November, December because of the Fed cutting and now the ISM turning.
Yeah.
Markets are reading the latest signals as reassurance. The Russell's strength today suggests investors believe the Fed can stick to its plans, most likely a September rate cut, without disruption. If Fed independence were truly in question, or if Jerome Powell's position looked unstable, we'd already see it in the VIX spiking and a broad risk-off move across equities. None of that has happened. Liz Thomas, speaking alongside Tom Lee, says the real debate may only emerge if incoming data turns out much cooler than expected. In that scenario, traders could begin to speculate whether the Fed should cut 25 basis points or go bigger with 50. But right now, the base case is still a 25-point cut. There's no real pressure from the bond market or the broader economy that would justify an outsized move. This matters because the Fed's credibility sits at the center of financial markets. Its independence, and the perception of independence, directly shapes how investors price risk. Any sense of political interference would be a serious problem. That's why, even though the leadership discussion is an unwelcome distraction, the Fed's decision to hand the matter to the proper authorities was the right call. It helps prevent doubts from seeping into market confidence. Let's get back to the interview.
Because I think the Fed's message is there's the court of public opinion versus the court of law. And if the court of law determines that there was cause, the Fed would actually support the decision. But I think they're making clear that there's just an accusation. But of course, there's a process to determine whether these accusations are true. So I think it's actually an appropriate response. And it does sound like it would be something acceptable to both sides because it is simply just saying if this is true, then there is cause. Sort of true. I'd actually think that the Russell's up today because the market's concluding the Fed can operate uninterrupted to proceed with a cut in September. Because I think if Fed independence is questioned and there's a risk even Powell's replaced, that would be a risk-off moment, and that would be the market we should see the VIX spiking and a general de-risking into a sloppy September.
All right.
Well, I do think people have to care. I mean, we're talking about the independence of the Fed here, and we're talking about what is going to affect financial markets and the voting members of the Fed that absolutely affect financial markets. But I completely agree with Tom. I think the Fed took a good, balanced approach with this to almost say, you know what, this isn't our decision. We're going to put this in the hands of the people who need to make this decision. Whether it's a distraction and they're frustrated by it or not, I imagine they are. However, it is the right thing to do to put it in the hands of who needs to choose how we proceed. It's unfortunate that we're going through this so close to a very important Fed decision on September 17th. I don't think that it will change what that decision will be. I think it was very clear at Jackson Hole, we're getting a cut, absent some really big shock or absent some series of shocks in the data to come. But even if we do see some hotter inflation prints, PCE this Friday, CPI before the meeting, I still don't think that changes the fact that we're getting a 25 basis point cut. Well, I think the market is reacting rationally. There isn't really much of a reaction. It's almost the absence of a reaction to it. We don't know what's going to happen, and I think the market realizes it doesn't necessarily matter what happens with this in the next couple weeks. What we are going to react to as market participants is if we get data that stops supporting what Powell messaged at Jackson Hole. So that being said, I still believe, even if we get some hot inflation prints, he messaged that we might get some hot inflation prints because of tariffs, and that is likely to be a shorter-term shock. We're going to monitor the situation. So even that probably doesn't change September 17th. I think the thing that we will debate, let's say data comes in much cooler than expected in these next three items, what we will start debating again is it 25 or 50.
I
think it's 25. I think it's 25. I don't think we're getting 50. I don't think they have to do 50, and I don't think the bond market is telling them they have to do 50.
Bitcoin's bounce on Tuesday may offer a brief respite for investors, but experts are warning that a deeper cooling-off phase could be in play. A combination of declining on-chain activity and sustained institutional outflows suggests that the market may be entering a more cautious period after a powerful run to record highs. Bitcoin's slowdown coincides with a period of elevated sell-side pressure from long-term holders. Momentum across banks, central policy, and digital assets is beginning to show how interconnected these forces have become. Financial giants stand to capture new streams of profit through technology, while the Federal Reserve's next moves will determine whether confidence holds or fractures. At the same time, Bitcoin's pause hints at how quickly sentiment can shift when liquidity tightens. All of these threads point to a market searching for direction as the year's final stretch unfolds. Will the balance between institutional strength, policy clarity, and digital adoption decide where capital flows most decisively next? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.